So yeah, I mean, I'll just quickly start given the paucity of time. So before we get into startup metrics, I mean, these are things that all of us would know. I mean, these are standard definitions of a startup. Perhaps maybe 5 years, 6 years earlier, they may not have been that prevalent, but I think now there's a clear, fairly good understanding of what a startup is. It's an organization which is fundamentally searching for a business model, a repeatable and scalable business model, right? It's not a highly profitable business which is generating, uh, positive cash flow, stuff like that, or it's not something which is creating wealth for the second generation, third generation, so as to say. It's an organization which has a fairly different objective. And a business model is something which essentially describes how your company or whatever you are doing creates, delivers, and captures value, right? So how does it create value? So if maybe it takes some raw material and it adds some value onto it, how does it deliver to the customer? Therefore, how does the company get to a customer? How does it discover a customer? How is it delivered? And how is it captured? So capturing value essentially means that you are able to charge customer an amount which is more than the cost of the value that you have added onto the product, right? So if you have bought a raw material for 100 rupees and done some processing for 10 rupees, and if you're selling it for 110 rupees, obviously the company is unable to capture value, right? You are unable to showcase to the customer that what you have added is valuable beyond the cost of adding the sort of cost value to it in that sense, right? So fundamentally, these are three things we are looking at. It's a repeatable, scalable business model, and I've just defined what a business model is. So therefore, the important startup metrics, whether it's from the perspective of a founder, because ultimately it's up to the founder to make sure that the startup progresses, and perhaps at times more importantly from the perspective of an investor, right? An investor may ask us questions which may look almost like conventional profitability, sales growth, etc. But fundamentally, an investor is also trying to assess these three things. कि आपका कितना बिजनेस मॉडल वैलिडेट हो गया है, उसमें आप वैल्यू कैसे क्रिएट कर रहे हो, कैसे डिलीवर कर रहे हो, कैसे कैप्चर कर रहे हो, and whether, let's say in your pitch or whatever, you have the metrics through which you're capturing it, because he'll ask you questions about those metrics. So you need to have those metrics and those data with you. So, I mean, I've tried to kind of, I would not say simplify it, but perhaps pigeonhole it or divide it into a few elements to make it simpler. I mean, by the end of this presentation, as an EA, all of you will be experts on all of this, but I think the important point is you will have some sensitization, and a lot of this material is available on the internet, right? The how of it is available, but what of it is something that I'm going to focus on, that what are the important metrics that one needs to look at. I'll explain all of them to some extent, whatever is possible in the short duration. But I think important point is sensitization, so that you guys can go and look it up, right? So I've sort of divided the metrics into these 4 or 5 elements, 5 elements. The first set is customer acquisition metrics, right? So, that's the key thing. When a startup is developing a new product or a service, the key thing that an investor or anyone, even the founder, forget about the investor, would want to know is whether there is customer acceptance, right? Whether the customer, because that's fundamentally the key challenge. As we all know that whatever, 50-60% of startups fail because the customer doesn't accept the product, or a startup ends up developing a product which the customer doesn't really need, right? So the customer validation is the key thing. So the first set of metrics that we are looking at is really metrics which tell us or tell the external world or an investor or stakeholder, etc., that yes, it seems that the customer is accepting their product. Second set of metrics is what I'm calling are the revenue metrics. So if the customer is accepting the product, and if we are able to charge the right revenue or pricing for the product, then we'll be able to create a revenue stream, a steady revenue stream. So customer acquisition in a certain sense leads to revenue getting created, right? So revenue is also a very, very important metric. A lot of investors will ask, "Aapka पिछले 3 महीने का revenue run rate क्या था?" अगले साल का run rate क्या है, expected run rate, those kind of things, so revenue is very important. In a way, it's an indicator of customer acquisition, though there are further elements in the customer acquisition metrics. The third very important element is unit economics, right? While I would say the first two elements are really about us being able to communicate, value to the customer, the third element is where we are talking about scalability and sustainability of the business model, and the fact that whether we are able to create that value within the organization, right? So what we call as the unit economics metrics. So for a startup, a profit and loss account may not be that relevant, because in any case, a profit and loss account is a outcome, which comes after 1 year or whatever period of time. But a startup is getting built day in, day out. So the important thing that to be noted is unit economics at a unit level, which can either be a customer or it can be a product unit or a sale unit. I'll come into that. The fourth important metric is, your operating break-even, because a startup obviously starts with a small number of customers, 2, 3, 5, 10, 15, 20. And that's why a startup needs funding, because, if you are servicing a small number of customers, obviously you are not generating enough cash flows to take care of your overheads and other costs. So unless you have X number of customers and Y percentage of those customers are buying on a regular basis, you will not have enough revenues and therefore enough margins to cover your overheads, which are your fixed costs. And therefore you will not be breaking even on a monthly basis, and therefore you will need some cash inflow, which is the reason why as a startup you need funding. So what is your operating break-even metrics? How does the break-even get achieved? What are the important drivers there to help you achieve that? And is it happening in 10 months? Is it happening in 15, 20 months? What is the timeline? And finally, what is your overall funding requirement, right? Which is a component of your monthly cash flows. And in some cases, it could also be a working capital, especially for startups which are building physical products or where there are payment cycles, right? The customer doesn't pay upfront or doesn't pay in advance. So in that case, the more you grow, the more your working capital requirement also increases. So your net cash outflow plus your working capital will give you your overall funding requirement. And once you do a long-term cash flow analysis sort of a thing over a 5-year period, you may end up with a valuation. Though at an early stage, the valuation doesn't happen through a conventional cash flow method. It happens more from market-based things and negotiation between a startup and a investor and all that. But I think it's good to at least have some theoretical sense of what valuation is in a real sense. So broadly, these are the 5 I would say key metrics that a startup needs to be at least aware of. Some may be more relevant to a particular startup, some may be less relevant, etc. That's a call that each startup or a founder needs to take. So I'll now quickly sort of go into each of these, just make sure that I'm mindful of the time. Yeah. So let me start with the customer acquisition metrics. As I mentioned, it's fairly important. Fundamentally, that's what a startup is doing. It's trying to acquire customers. So what are the 4-5 metrics that are important here? I think I put 5 metrics. They could be more, they could be less. But broadly, I think these are the 4 or 5 elements which are important. One is activation. What does activation mean? Essentially, what it means is that if I reached out to 10 customers, or if I went and met 10 businesses or 10 individual customers, how many of them converted or how many of them bought my product, right? So a higher percentage activation rate is always good. A very low percentage activation rate essentially means one of the 2 things. A, perhaps we don't have clarity on who our core customer segment is, right? Therefore, we are going all over the place. And, by serendipity, we are meeting out of 10 2 core customers and both of them are converting. While the other 8, we are essentially wasting our time and effort trying to meet them because they are not our core customers. So therefore, were we focusing on our core customer, our activation rate may have been 100%, but now it's 20%. So it could either mean that, Or it could mean that we are going to our right target segment, but the product is not something that they are desperately looking for, right? Or maybe it's a product which kind of forces them to do some change in their habit or whatever it is, and therefore the acceptance is low and the early movers are taking it, but the other ones will come later. But I think this is a very, very important metric, right? It's also called virality, but I didn't use that word for obvious reasons. Let's use the word activation for the time being. The second important metric is your customer base. Now, this might sound very logical and intuitive that, I mean, what's so great about it? Customer base to hai. But, I think a very large percentage of startups, significantly large percentage of startups or new businesses do not have a sense of who their customer base is. In other words, a lot of startups don't know who our customers are, or they don't have information, data, or some sort of whether it's a CRM or a database where they can access their customer base, right? They are more focused on revenue growth and outcomes rather than the inputs in this case, right? So you need to be very clear as to what your customer base is. These are my customers. My customer base is 1,256 customers, out of which we'll come to that later. So customer base is essentially those customers who have at least bought your product once, right? So they should be somewhere in your database. You should have the ability to reach out to these customers. Maybe once you become a national level company, even then you need to have, but definitely as a startup, when you are acquiring hundreds or thousands of customers, it's very important to have a clear sense of who your customer base is and access to it. The next important metric obviously is customer retention or customer churn. आपने 1000 customers बना लिए. These customers have bought your product once, but how many of them are buying the product more than once? This is again a very, very important factor, and I have written it down in my slide as to why it's important. Because I mean, there are various studies which say that it's much more expensive to acquire a new customer than it is to retain. So again, if you look at from a value creation perspective, if you have a higher customer churn, that means your sales are growing, but it's really growing from new customers that you're acquiring rather than you retaining 80-90% of your existing customers, then you are actually not creating value in the company, because you might be spending more money trying to acquire new customers. And once a customer is acquired, he tries your product once and then he disappears. And there's a leakage. It's almost like there's a bucket and there's a perpetual leakage. You're trying to fill it up, but 60-70% of it is continuously leaking. So this is very, very important. I mean, if an investor asks you a few questions and he figures out that there's a customer churn, then that's the end of the story, right? It's very important to retain customers. Maybe it's not 100%, but it needs to be significantly high. Because it also in a way indicates perhaps that you are sort of overselling to customers who may not be your core customers, and they may buy once because you're giving some sort of a discount or whatever, you're overselling, you're overpromising or whatever, and then they don't have an incentive to retain or to repurchase. So this is very, very important metric. I mean, all of them are important. I'm sort of saying very important for all of these because that's the fact. I mean, they have to be measured. So when I'm saying these are the KPIs, you need to be measuring them on a monthly basis. Every month, at the end of the month, even if you are a one-man startup or 2 founders, it doesn't mean that you need to have a team of 20 people and a sales guy coming in and this guy coming in. Even if it's two founders, you should be spending half a day on the first of the next month or whatever, and looking at where you are vis-a-vis these metrics and the other ones that I'm going to talk about. The other metric is active customers. Right now you may have, let's say, 1,000 customers, out of which 100 have just disappeared. They are not picking up your phone. I mean, they are out of the system. Out of the 900, maybe only 500 are buying every month. I mean, when I'm saying every month, the activity of a customer really depends on the type of business. So some businesses would be such where you would want where the customer activity is once a month. or the ideal state is that a customer buys once a month, right? Some businesses it could be once a day. If you are like selling milk or something like that, then customer should be ordering every day. But if you're selling, so I don't know. So depending on product to product, it can vary. But whatever is the customer activity for your type of business, active customers are those customers who are fundamentally purchasing from you. You are their default customer. There may be some inactive customers who are maybe buying once in a while. So they are perhaps buying from some other customer, and when that customer is, some other startup or some other supplier, and when perhaps the supply is not available, they are looking at you as a second or a third option or whatever. So it may not be a dead customer, but it's a fairly inactive customer. So in terms of the action, you need to essentially convert an inactive customer to an active customer, right? I mean, that's so once you know what your active percentage is, and once you know who you're, so essentially, if you look at it, the third metric tells you the customer churn. Fourth metric tells you that, okay, the customers that you've been able to retain, how many of them are active? So the gap between them are inactive, which you need to convert into active. Otherwise, at some point of time, they may go out. They may become part of your dormant customer base. So this is an important metric, and it's also important because it's the active customers who actually build your revenue top line, right? It's not the dormant and the inactive customers who add to it. I mean, they are, blips in the sky. They'll sort of give you some sales here and there, but fundamentally your sustainable revenues are built by the active customers. So you need to know what your percentage is, because these guys have to be retained. Not only do they have to be retained, you need to be able to increase their ARPU, which is the next metric that I'm talking about. So once you have, let's say 60%, 70% active customers, what is the average revenue per customer or per user, as they normally say, right? Because, one of the objectives should also be that once you have retained a customer, right? Because as a startup, you will typically not start with 100 products or multiple SKUs unless you're a platform or something like that. You will start with a few. But once you start engaging with the customer, you might realize that this customer also needs a different size or a different variation of this or that. And that's where your product development comes in. So you try to develop more relevant products to increase ARPU. You will not develop products because you like developing products, right? So that's another mistake that a lot of startup founders make, that एक ये specification आ गई, अब यार ये भी बना देते हैं, ये भी बना देते हैं. All of these, your product development really needs to focus on this. Either it needs to create a new customer segment. Maybe you realize that your current customer segment is saturated, or it's not giving you a relevant ARPU, which is not covering your overheads. So you need to create another product or a variant which gets you access to another customer segment, or it's the same customer segment and increases ARPU. That's actually better, because if you are going for a new customer segment, that means you need to start this entire funnel again. You have to activate, you have to retain, you have to activate or sort of make sure that it's an active customer, so on and so forth. So these are the 5 important customer acquisition metrics. I'll just move on because we have less time. As I mentioned, this presentation is not going to give you 100% command over creating your KPIs, etc. But it's a starting point. I can share this presentation also with Deepak, and he can further share it with you folks. Now, as I mentioned earlier, your customer acquisition leads to the revenue. So in fact, if you are sort of, let's say, projecting your revenues for the next 3 months, right? It should essentially flow from the earlier metrics, which is what I have tried to show here. So your revenues, in a certain sense, is your customer base into your active customers, into your average revenue per user, into the purchase frequency of an active customer, right? So your revenues for the next month or the second month or the third month need to be derived from what are called as revenue drivers. So all these 4 are revenue drivers. So, your sales team or your, for a startup, maybe this founder is the sales team. Maybe there are 2, 3 co-founders, one guy who's looking at sales, one guy is looking at purchase or whatever it is. You need to be focusing on the drivers rather than the revenue, Because the fact is that you can't control the revenue. You can only control your customer base. You can control your active customers. You can control ARPU, and you can control your purchase frequency. So these are your drivers, and therefore they become important. So the point which I'm trying to make is the importance of having all those customer acquisition metrics is that once you start tracking it, your revenue starts building up at a molecular level from these drivers, and you know exactly what is happening. If the next month revenue is lower than the target, it could be because your customer base is small. It could be because your customer base has increased, but your active percentage customers has reduced. It could be that both have increased, but your ARPU has reduced. It could be that all three have increased, but the purchase frequency has reduced. And each of these four elements will require a different action, right? Because you want to correct it in the third month or whatever, subsequent month. Now, unless you don't know what drives your sales and therefore what are these specific elements, you would not know what to correct. So this is the revenue metrics. Fundamentally, revenue metric is nothing but your customer purchase frequency and how the revenue gets built from the previous metrics, right? So customer acquisition metrics, revenue metrics. कस्टमर एक्वायर किया, रिटेन किया, उसने माल खरीदा, इतने का माल खरीदा, इतनी फ्रीक्वेंसी में खरीदा, रेवेन्यू आ गया, एक चीज खत्म हुई. नाउ वी आर कमिंग टू यूनिट इकोनॉमिक्स. Sorry. Unit economics essentially gives you a sense of the fundamental profitability of the building blocks of a startup, right? Because a startup at the initial level will have only few customers, few products, etc. And there is no way that you can use conventional metrics of a profit and loss account to determine the profitability, right? So the profitability needs to be determined at a fundamental unit level, which can either be the customer or it can be some other unit like a product. In some cases, it can even be a geographical entity like a sales office or something like that, or a branch office. So fundamentally in unit economics, there are these 3-4 elements that you need to be mindful of. One of the biggest components of a unit economics is the customer acquisition cost for a startup, because majority of the money that a startup, once the product development phase is over, it goes into acquiring a customer. And the reason why you end up spending a lot of money is because at times, more often than not, you don't have a clear sense of who your customer is. So you are doing hit and trial. ये भी कर लेते हैं, ये भी कर लेते हैं, ये भी कर लेते हैं, till you get a sense of कि कहाँ पे efficiency best आ रही है, where my customer acquisition cost is the lowest. Fundamentally, that's the key metric. So if you do 3 things for 3 different customer segments, let's say 100 rupees here, 100 rupees here, 100 rupees here. First one, you are able to acquire 1 customer, second 2 customers, third 3 customer. So your customer acquisition cost of strategy 3 is 100 by 3, 33 or whatever for the third one. Second is 50, first is 100. So then you know what you need to be doing. So obviously your unit economics of what you are doing in strategy 3 or customer segment 3 is going to be the best, right? So maybe you need to focus on that. Second important concept of unit economics is your customer lifetime value, which means that once you have acquired a customer and once you have retained a customer, over the lifetime, how many times, how much of your service or product does he buy, right? So if you have, let's say, acquired a customer for 100 rupees and the customer only buys 60 rupees of material from you. Actually, it's not 60 rupees, but it's 60 rupees should be the contribution, because you'll have to remove your costs, all your direct costs, etc. Because what you get is essentially the gross margin. So let's say 60 rupees is the gross margin of the products that the customer buys. That's not a profitable customer unit economics, because you should be, or the customer should be buying enough such that you are able to recover the 100 rupees that you spent on acquiring the customer. Or the other option is that you reduce your customer acquisition cost somehow, right? You try something else out so that your customer acquisition cost becomes 30, right? So obviously, which is the third point which I'm mentioning here, that your life cycle value, lifetime value needs to be greater than the customer acquisition cost. Now, this is over a lifetime. There may be some products where the lifetime of a customer is 2 years, 3 years, right? But a startup doesn't have that sort of a horizon in mind. So the way a startup can use the unit economics in a more short-term way is to look at all of this at a product unit, right? So let's say if I'm selling 1 unit, my customer acquisition cost on that unit plus whatever is my direct cost of making, selling, or distributing that unit. These should be less than the sales price that I charge from the customer. So if I'm selling this cup for 100 rupees, my customer acquisition cost, I mean, it's possible that I may buy this cup after 6 months again. But, again, as I was mentioning, that's the first benchmark that you will use, which is a lifetime value, which is 6 months. But I also want to make sure that I am able to recover the value or the price or the cost of this product in the more near future, right? In maybe 2 months, 3 months, or something like that. So if my customer acquisition cost, if I'm selling it at 100 rupees, then my customer acquisition cost and my direct cost of selling the product and making the product should be less than 100. Right? Then only I'll have some sort of a contribution which can take care of some of my overheads, which are my fixed costs. Right? So this is again a fairly important metric. One is your lifetime value needs to be greater than the customer acquisition cost overall. I may buy this cup multiple times, right? But more importantly, I should also be able to recover the customer acquisition cost in a foreseeable future, right? Maybe 3 months, 6 months, because I need to achieve break even in 12 months, 12 to 18 months. So if my customer is only breaking even after 2 years, it's not going to work out. Right? So at a product level, I will use the customer acquisition cost to do my product unit economics and make sure that in a 3 to 4 month, 5 month foreseeable sort of a horizon, if I'm able to assume the number of times the customer buys that product in that 3-month period, my product unit economics is positive. So I'll stop here. This may be slightly complicated. Actually, it's fairly simple. I mean, once you put your mind to it, you'll figure it out. So this gives you a sense of the unit economics at a molecular level in a startup. When you have maybe 10, 15 customers and you're selling a few units on a monthly basis. So if your customer unit economics and your product unit economics are positive, if you make more products and you make more customers, obviously at some point of time, you will achieve break even, which is really the next set of metrics that I have. So essentially, I think again, I won't go too much into details, but the fundamental point here is that a startup, for the first few months, till the time it has enough customers who are buying at a certain frequency, till the time, the revenue, the margin that you are able to get from that certain number of customers, it equals your overheads. Till that time, you will need money. Right? That's the reason why a startup raises funds, because, you may need 1,000 customers and 80% customers to be active, buying twice a month at an ARPU of 500 rupees for you to achieve break-even. So that's your break-even equation. But for you to achieve that, whether it's in terms of number of customers or the retention or the activity rate or the ARPU or the purchase frequency, all these 5-6 drivers, to be able to achieve all these drivers all together might take you, let's say, 12 months. So your break-even, operating break-even on the monthly basis will happen in 12 months. So from month 1 to month 12, you would need a cash inflow from some investor or whatever it is to take care of that operating loss. Right? So this sort of operating break-even statement, if I may use the word, gives an investor a sense of how you are closing in the gap and at what stage are you becoming operating break-even and what are the key drivers and how are the drivers moving. So fundamentally, it's a combination of your revenue build-up and your unit economics, right? So at some point of time, once you have enough customers and your unit economics are positive, each of your customers is delivering enough of a positive contribution such that if you have N, which is the break-even number of customers, your total positive contribution equals the overheads, which is your fixed overheads on a monthly basis. Then we say you have achieved break-even. So that's an important milestone for a startup. When, as a startup, we are going to an investor, obviously we haven't achieved break-even, operating break-even, which is the reason why we are going there. but an investor would like to see it more so now. I mean, one could have taken a valuation sort of an approach that, I'll break even after 5 years, 4 years, 3 years, and, there'll be second round, third round, fourth round and all that. But I don't think that logic will sort of hold anymore. When we go to an investor, there should be a clear operating break-even sort of a horizon. This is when we break even and this is how we break even. So that's the fourth set of metrics. And finally, we have, and I'll probably focus the least on it because it's really a combination of all the other four, right? So using the other four important metrics, you will try and create a 5-year financial model. You will basically try and see that how will the sales increase, how will your cost drivers change, what will be your contribution, what are your overheads, what is called as EBITDA, what are your other fixed assets, other finance costs, what's your cash flow, and therefore once you aggregate it, what is your funding requirement? And there is something known as net present value, which is nothing but your valuation. As I mentioned towards the start of the beginning of the presentation, the net present value approach is probably not the approach that startups do for valuation, because there's a lot of uncertainty, right? Because your next target really is to achieve break even. So 5 years is too long a timeline and a time horizon. So while you may want to do this at a theoretical level, but ultimately the valuation at which you might want to raise funding happens through a negotiation process. And there are some market benchmarks that we look at. There'll be some other things that an investor looks at: your risk profile, what sort of a team you are, what is a market that you're operating in, so on and so forth. There'll be a whole lot of qualitative factors also which will come to it. So I think with this, I'll come to the end of my presentation. I've already taken about 40 minutes. I am very sure that some of this may not be very, very clear. I kind of quickly ran through it, but I think the important point here is, again, I'll go back to my the first slide or the second slide, where I'm really talking about the type of metrics which are very, very important from a startup perspective. I'll just quickly summarize them again before I stop. So your customer acquisition metrics, your revenue metrics, your unit economics, operating break even, and your slightly long-termish cash flow kind of analysis, right? So I think that's it from my side. If there are any questions, I'll be happy to take.